Franck is a vice president for Exchange Resources, Inc. Prior to Exchange Resources, Franck started his real estate career in 2005 with Star Real Estate and RE/MAX, learning the ropes and developing relationships with his customers. Over the years, he has brokered over 1,000 real estate transactions ranging from resale to new home sales with Brookfield Residential to the facilitation of 1031 exchanges and selling investment properties, including Delaware Statutory Trusts. This broad background has provided Franck with a keen understanding of the needs of investment property owners and how to guide real estate professionals with his 1031 exchanges. So Franck, welcome you.
I'm going to get the clicker right there. Well, thank you for having me, Bruce and Karen. I appreciate it. Something new, I was asked to do the presentation in French. I hope it's okay with you. Okay? How many of you speak French there? Okay, good. All right, so today we're going to be speaking about 1031 exchanges. So it's a little section of the code that basically allows a taxpayer to defer the gain on when they sell a property if they reinvest, sell an investment property and reinvest the gain in another investment property. So let's talk about exchanges for a few minutes. So, like I said, it's a great tool, one of the last tax shelter in our arsenal for real estate investors. And a great way to not only defer the gain on your properties, but also it offers so many great benefits. Now, some of the great benefits, as many of you may know, the accumulation of wealth, maybe allowing for opportunities to improve your cash, your equity return, right? Getting a new depreciation schedule, you know, that's very important as well, and that you can see the result of that every single year when you file your taxes. Also maybe diversification, relocation, getting better properties, bring a property closer to you if you happen to move out of state and so forth. And also could be an estate planning tool. So those are the real benefits of 1031 exchanges. Now, let's talk about Washington, D.C. and what's the plan for exchanges. I know every time we have, seems to have a new administration, the subject of 1031 exchange comes back on the table, right? That happened again recently, earlier this year. It was planned to the Biden administration's proposal was to cap the total gain exclusion to $500,000 per taxpayer. Well, fortunately, this is off the table for now, okay? So there's no changes that are happening next year, so we are okay on that. So exchanges, all of the rules are to remain the same for the next year and so forth. And the Federation of Exchange Accommodator feel pretty confident that it's going to stay like that for a little bit longer. However, we need to stay very vigilant about changes to the tax code in regards to exchanges, right? So I have a little link at the bottom. I'd be happy to share that with you when we are done, but always keep your ears open, you know, if when you hear about 1031 exchange and changes in the code in regards to that. We want to preserve those exchanges. It really has helped many taxpayers, and actually middle America, get wealthier and wealthier because of the 1031 exchange. So talking about Americans building value with 1031 exchanges. So since 1921, exchanges really have stimulated capital investment in the US and contributed to strengthen the economy as well. So that's really a great plus for the economy. So just to share a few numbers, there was a study done by Ernst & Young in 2021 in regards to how 1031 exchanges impact the overall economy. So for 2021, see that about 976,000 total jobs were created, 48.6 billion total labor income, 97.4 billion total value added, and finally about 13.1 billion in federal, state, and local tax revenues, right? Typically, the argument from our elected officials when we talk about getting rid of exchanges that it's going to raise more tax, it's going to be a benefit for, you know, for the economy and the government. Well, in fact, when you look at those studies, it's pretty clear that exchanges do add to the economy and do bring a lot of revenues for our country. Market trends. So What we are finding, at least for last year, we are seeing an increase in investment in passive type of investment, like for example, Delaware Statutory Trust. We are seeing a sharp increase on those from last year, which stood at about 4.3 billion in capital raise in that space, especially in the multifamily space. This year, as of 9/30/22, we are at about $7.6 billion we are invested in those type of program, those Delaware Statutory Trusts, or DST as we call them. 1031 identification issues are still going to remain an issue in this coming years, 2023, as there is definitely a lack of inventory. So that's going to be somewhat difficult. So it's when those passive investment like DSTs, may play a role in that, or actually help the investor looking for replacement properties. More cash transaction. We are seeing more cash transactions, higher dollar amount as well. So a lot of that happening. A lot of investors too are looking to go like a hybrid, going from multi-unit properties like apartments and going maybe to a nice 2-unit or maybe a single family home and an ADU in the back or something like that. So we are seeing quite a lot of investors transitioning to larger unit, to something a little bit smaller, where maybe later on they can move into the main house and rent out the properties in the back. So we are seeing quite a few of those. And of course, you always have people looking to move out of those high state taxes and to more friendly tax states. That's definitely, one of the reasons why people are leaving California or states like New York and so forth. Now, let's talk about, what I want to do today is kind of recap the main rules of what makes a 1031 exchange successful. We have a lot of questions on that. It can be very confusing. So let me kind of do a quick summary of what the rules are. Number one, the property that you're exchanging have to be like-kind. What does this mean to be like-kind? Like-kind means investment real estate for investment real estate. The confusion is, I have, let's say, a fourplex, but I really want to buy a single-family home, or I have a condo and I want to buy a piece of land. Can I do that? Well, yes, you can do, as long as it's held as an investment property. How do you show that an investment property is a real investment property? It's by reporting that property on your tax return by filing a Schedule E. That's very important. And to hold it for a couple of years based on the safe harbor guidelines. So like kind, we talk about that. The replacement of the property should be of equal or greater value of the sales price of what you are selling, right? Some people think, well, I only have to replace the gain. Let's say I have a gain of 300K. That's the only thing I have to, replace. That's not correct. What you have to replace is a net sale price. So to give you an example, let's say you have a property for $1,050,000, right? Your non-recurring closing costs, like your commissions and your escrow title fee, come to about $50,000. Your net sale price is $1 million. That $1 million is what you have to replace. You have to buy equal or greater to the $1 million, right? If you have debt on that property, let's say you have a loan you have to pay off for, let's say, 400K, right? So now your net proceeds are going to be 600, right? Well, the 600, again, is not what you have to replace. You have to go back to the net sale price. So you want to replace that 1 million. So what do you do? How do you replace the 400K that you just paid off going on to the next property? Well, you're going to have to get either a new loan or bring some new cash to the table, right? But if you happen not to replace that debt that you just paid off, then that's what we call a debt boot or a mortgage boot, and then you will be taxed on that money you're not replacing. Same thing if you leave cash in the exchange, maybe you want to pull a couple $100,000 to do, maybe to go on a big worldwide vacation, for example, then you're going to be taxed on that 200K as well. So it's very important to replace the net sale price of the property, not just the gain and not just the net proceeds. And the debt has to be replaced. Very important. Let's talk about the time frame. So a lot of questions on when does the exchange start? When do I need to open an exchange? Well, you need to open an exchange when you are in escrow. It's amazing how people call us and say they just closed escrow on a property, and they call us up and say, okay, my agent just told me that I could do an exchange. Well, I'm sorry to tell you, but you just closed escrow, it's too late. Even if that taxpayer is not in receipt of the funds, right? Even if those funds are still in escrow. that still constitutes like a constructive receipt of the funds. So that's not going to work. So very important to set up an exchange when you are in escrow, before you close escrow, okay? Now the timeline is going to start the day you close escrow. Not when you get you get a property on the market, or not when you get an offer on that property. It starts the day you close escrow. So you're going to have a total of 180 days to close your, basically to wrap up your exchange, right? Now, the first 180, the 180 days to do your exchange, with the first 45 days to identify specifically in writing what you're going to buy, okay? So you have a couple of ways of identifying. We can talk about that later, but basically, we would provide you a little form, and then on it, you would have to write specifically what property you're going to buy, right? It cannot be vague. It has to be specific addresses. And then you can change, what you put on that form when you are in the exchange, in your identification period within those 45 days, but there is no extension. So if you happen to be in escrow, and let's say on day, 46, that your property is falling out of escrow, then it's too late. You cannot go and find another property, identify another property. So it's very important to identify property within that first 45 days. There is no extension whatsoever. And if some people tell you that you can, or companies that tell you that you can, then I would be very concerned working with that company. Because like Matt says, the risk of an audit is very important. And then when you may get audited, it might not be 2 weeks after you close escrow. It might be 3-4 years after you close escrow, right? And not only your exchange will be invalidated, but also you'll be paying penalties and late fees and all kind of stuff that you don't want to really look at, okay? So that's very important. Finally, the taxpayer selling has to be the taxpayer buying, right? So you cannot have change of person or entity between the sell and the buy, right? So all we are known to the tax people, we are known as a tax ID number, right? So if I'm selling a property as Frank, I'm the one who has to buy the replacement property, carrying the same social security number. The issue comes in when we work with partnerships, LLCs, corporations that own real estate. Those LLCs or the partnership, most of them would be filing their own tax, or so they have their own tax ID number. Well, the corporation or the LLC can do the exchange, but the issue comes is you have, like, say, 3 partners, and they want to split up. They want to move on and do their own thing. Well, that's really an issue, because you cannot just dissolve that partnership and have the 3 partners go their separate ways, the day after you do the exchange. It requires some proper planning to do that. It can be done, but it's not, a quick fix. It may take a couple years, before you do that. So proper planning is very important. We can talk about that later too. So that's basically the main rules, right? Like kind can buy investment for investment, real estate investment for real estate investment. The replacement should be of equal or greater value. The amount, we talk about that, and then the window, the timetable, 180 days from the time you close, and the first 45 to identify, and the taxpayer needs to be the same. And I would like to conclude with a couple little tidbits and noteworthy exchange application. I don't know if you know, but you can convert an investment property into your principal residence, right? As long as you have held that property, that investment property, for a couple years before you do that. And that can be a great tool for some people that are looking maybe to retire in 3-4 years down the road, and they own a nice little fourplex, but obviously they don't want to live in it. They'd like to maybe live by the beach or something. And so they can sell their fourplex, exchange it maybe into a nice little home by the beach, and then rent it for 2-3 years, and then convert that property into their principal residence. So it can be a nice little tool, in that application. The other thing that is really nice is that the nice little gift from the IRS is that you can combine that 121 universal exclusion, which gives a taxpayer for their own principal primary residence. You get $250,000 if you're single, or up to $500K if you are married filing jointly. Then you get that if you're selling your principal residence, you can basically exclude the $500K and put that in your pocket. Well, you can combine that universal exclusion, 121 exclusion, with the 1031 exchange as well. And that's really key, and there's a lot of application for that, because when you look at, for example, Orange County, San Diego, Los Angeles market, you'll find a lot of properties that have greatly appreciated over the years. It's not uncommon to find properties that are appreciated for $1 million, maybe $1.5 million. So if you can only exclude the $500,000 gain on that property by selling your primary, you're still going to be exposed with a pretty big amount of gains that you have to pay tax on it, right? So with a little planning, you can take that primary residence, move out of that property, and rent it for a couple years, and then later on sell it, and then you would be able to get the $500K universal exclusion if you're married, and then do an exchange with the rest of the proceeds. So if you have, for example, a property is worth $2 million, you will take the $500K off the top, put that in your pocket under the 121 exclusion, and then with the $1.5 million that is left over, then you can do an exchange with that. So the great strategy for highly appreciated properties. A lot of people are doing that, especially in our market. Anyway, that will conclude my presentation. And thank you for being here. And if you have any questions and want to consult privately later on or by phone, I'd be happy to do that. Thank you so much.